Today we're having a look at what makes up a trading strategy. A strategy is not a single indicator. You need a confluence of multiple conditions to qualify, first of all, for your trade entry, and then you got everything else like risk, where to take your profits, and just everything that you need to extract money from the market. Now, once you have a strategy that is tested thoroughly and proves to be profitable long term through every single kind of market condition, including COVID, wars, everything like that, different volatilities and volumes traded throughout the years, and it's profitable throughout all of that, you can trade stress-free because you know you're going to make money through any market condition. What is a trading plan? It's a personalized, rule-based framework, and I've highlighted rule, and it outlines how you trade. It covers your strategy, risk controls, goals, and daily process. Why does it matter? So since it's rule-based, it removes emotion because all you've got to do is follow your rules. Following your rules builds discipline and helps you stay consistent. This allows you to review and refine your strategy over time, and it keeps you calm during random market events. So with this, you have to be realistic with your account balance or your account size. So you have to set clear, measurable objectives for your trading success. So for example, maybe 3 to 5% a month. So if you got a 10K account, 3 to 500 a month. That's just how it is. You're not going to make millions and millions of dollars like these gurus online. You're going to make based on what your account size is. So align your lifestyle with your risk tolerance as well. So how much time you can actually dedicate to trading. If you're working full time, you might take less trades and you might look for higher time frame, better setups. And also how much money you're willing to risk. Everyone's risk tolerance is different and it depends on the individual. So whatever you're happy with is what you'll add in your rule-based plan or system. And you got to make sure your goals are realistic and sustainable long term. Just for your peace of mind, you need a solid plan. And this solid plan will create structure, clarity, and confidence in every trade you take. You'll need to use indicators, use prior knowledge of market structure and price behaviors to help you come up with a plan. Once you think you have a plan, you'll need a back test and forward test to make sure that it works long term. And the reason I keep highlighting long term is because every strategy will have maybe a losing month. And if you have your first month of trying your strategy and it's a loss, hopefully you don't system hop, because that is the number one killer for traders. Is you don't make money, so you hop to a new system. It makes money for a little bit and then it doesn't, and then you system hop once again. This is detrimental to your trading success. So you need to back test years and years and years of data to make sure that it's profitable long term. Because if you start out and you have maybe a losing month, you know that the next coming months are going to be profitable. Now that you know that it's profitable long term, you can relax more because you know that it's profitable. Stick to the plan that works. So risk and risk management is different to every person. Your job as a trader is to manage your capital. If you lose it, you'll have nothing to trade with. Back to McDonald's. Your position sizing should be based on your account size as well as what you can personally handle as a trader. You're not going to over leverage. That's also going to kill you as a trader. A lot of risk management comes back to psychology and sticking to your plan. You might see a nice A+++++ setup and you think, yes, this is it. I want to enter bigger than what I've been doing for the last month. So you enter with a bigger lot size because you think it's good, and lo and behold, you lose that trade and all of last month's profits are gone because you broke the plan. So the system you make up needs to give you an edge, meaning you're going to win more than 50% of the time, no matter what. Ideally, it has to have mechanical rules that are easy to follow. So sometimes you may look at a friend's chart and be completely confused about what the fuck you're looking at. They may be drawing trend lines using random indicators they found on Instagram, boxes, purple lines and crosses. You get the point. Just keep it simple. You should be able to quickly see your confluences lining up and know when or when not to enter the market. So this right here is an example of what you'll need when you're trading with dollar cost averaging. And this is actually using my software that I've made. So the first thing obviously is going to be risk. You need to know how much you're willing to risk. As we get into this course further and further, I'll explain more about what these are. So as you're dollar cost averaging in, you're adding in to losing positions. So you need to have additional entries, meaning the space between your first, second, third and fourth entries as price goes down, waiting for its snapback for you to take your profits. You'll need a multiplier as well, so as the price moves against you, the position sizes get gradually bigger, helping you get out of these positions. You'll need to know when to take profits, when to do drawdown control, when your first entry signal would be, and where the second one will be. This is just an example of what gives me peace of mind. So this is my bot running with my strategy. I can see I've tested since 2016 to now 2025. As you can see, it did have a losing month during COVID, March 2020. It also had a slight loss during the Russia and Ukraine kerfuffle that happened. But as you can see, the account did not blow. So 2020 was the only losing year. The rest, we made nice profits. So now that I know that long term, on average yearly, I'm doing about 30%, 33%, and I'm not going into crazy drawdown, and I've got a nice over 50% win rate, I have confidence in this trading strategy and I'm going to use it. So my strategy is made up and I know when exactly I need to enter or leave my positions. Meaning I'm not going to get FOMO or I'm not going to over leverage because it's all set up and ran by my bot. So the parts of the machine, this is just going to be showing you sort of the 5 metrics you can look for trading strategy. So our signal indicator could tell us to get into a trade or gives us a possible trade idea. So as you can see, for example 1, we have a break of structure at the market open. So this purple box here is the London trading session and it's got previous support and we break it. So we've broken structure and we take a short. That's a signal right there, the break of structure. Secondly, we have a moving average cross above, so we sell, below, so we buy. These are just simple metrics, and now it's time to check that your other conditions line up. For an extra confluence, you could use a trend bias indicator, which shows you the direction of where price is heading. So you may find this by looking at a moving average or just the trend from a higher time frame. This is just basic, so if it's below, buy, if it's above, sell. Now we're going to have a look at confirmation indicator. So this is going to back up your trade idea. So we can use this by looking at maybe the relative strength index. And what this is going to do is it's going to filter out bad trades, give us fewer entries, and increase our probability of success. So remember I said the moving average cross could be considered an entry. Now if you pair the moving average cross on a lower time frame with a relative strength index on a higher time frame, you can see from the higher time frame that if the relative strength index is up, that pair is probably overbought, meaning it needs a pullback. So since we're waiting for this pullback to happen on a lower time frame, we can see when the sellers are stepping into the market by looking at the moving average cross. That's using 2 confluences in your trading plan right there. By using 2, you're going to get fewer entries, but you're also going to increase your probability of a successful trade. Instead of just basing it off moving average crosses or relative strength index, you can also use key levels or areas of interest such as support or resistance as a nice entry to begin your dollar cost averaging. So you might come here to this previous level and you might start entering your sell positions. Price eventually will snap back. You might come here, add your buy positions. Here, sell, and just so on and so forth. Over time, you'll just see how these zones are touched over and over again. Now, for your targets, you can use your signal indicator in the opposite direction as an exit, or you can look at levels such as support and resistance or wide range bars. Now, I like using wide range bars because historically price likes to retest and touch areas where it has before, especially where there's large bank and institutional trade orders. So we have these gaps in our candlesticks because there's a massive buy, which means price is likely going to come back and retest it because it needs to come back to that original buy, and vice versa for sells as well. It's going to move between these zones over and over again, much like support and resistance. Just to summarize, so number 1, we have a signal indicator which will tell you to get into the trade, so like the moving average cross. Number 2, we have the trend indicator, which could be the moving average from a higher time frame or a higher EMA, showing you the direction which you'd likely maybe want to take, or you could look from a higher time frame to see what the trend is. Next, we're going to have a market condition or confirmation indicator, which backs up your trade idea, which could be the RSI from a higher time frame. Fourth, we have a level of interest, which personally I think is a really good level to enter or exit your positions, and this would be support, resistance, or supply and demand. Last but not least, we have the target or exit indicator. The price is likely to touch again and where you can get out of your position. So later on, as this progresses, I want to get more into how to actually backtest and find your own strategy that works long term. So if you enjoyed this video, subscribe because more free shit is going to keep coming out. Cheerio! Which is where